For weeks, all the attention in the US Treasury market has been on higher yields. Fears driven by questions about Fed independence, the impact of high import tariffs on goods prices, and ongoing expansionary fiscal deficits. On the surface, it all points to even more pressure on long bond prices. But if you look at the price action itself, those fears may be overstated. The market is starting to signal a very different story, that long bond yields could actually move sharply lower, despite the prevailing narratives. And that's where the technical picture comes in. Because when we're assessing future bond supply, demand, nominal growth, and perceived unforeseen risk decades out, price action isn't just a reflection of reality. It can actively shift the narrative. Let's take a look at what the charts are telling us. The daily chart you're looking at is the UB futures contract. Ultra long bonds traded on CBOT, the underlying is the 30-year Treasury bond. And there has been a distinctly bullish move over the past 4 days on the back of pretty decent volumes. Started with an engulfing candle, then a break of a descending channel, and then an extension of that bullish move through firstly the 50-day moving average, a minor resistance level, and then a more pronounced resistance zone comprising of the very important 200-day moving average and horizontal resistance. The move has then stalled at a downtrend that dates back to the highs that were set in September last year when the Fed was in full bore easing mode. When you go and zoom out further, it shows that the contract sits in what's called a falling wedge, which is a bullish continuation pattern. Of course, we've seen that long bonds have been under a lot of pressure recently, so the signal may not be as reliable as usual. But if we were to go and see the price break out above this downtrend, it points to the potential for a move back towards the highs that were set in September last year. What would such a move mean for long bond yields in the United States? Because of course, price moves inversely to yields in fixed income markets. Well, this next chart gives you some insight. The high that was set back in September last year in UBs, if you look in the right-hand pane, it coincides with 30-year yields in the States falling beneath 4%. That would be a meaningful decrease, more than 70 basis points below where they currently reside. If long bond yields move sharply lower, the implications could be significant. In a normal cycle, it's rarely a positive sign for the US economy. It usually signals slower growth and heightened uncertainty. That kind of environment tends to favor long duration assets over cyclicals, which often struggle when growth stalls. The key now is to watch the price action closely in the coming days, because it will be the clearest signal of whether this perceived shift is taking hold.